Accounting for transaction and shareholders' equity. Under contributed capital, we have the following three journal entries. In our first journal entry, in addition to shares being sold for cash, it is also common to see companies selling shares on a subscription basis. In these situations, the buyer usually makes a down payment on purchasing a certain number of shares and agrees to pay the remaining amount at a later date. Here, we debit cash and credit common shares. In our second journal entry, the share subscriptions receivables functions are similar to the accounts receivable account. Once the receivable payment is paid in full, the common share subscribe account is closed and the shares are issued to the purchaser. This means there is down payment, receivable, and common share subscription. The journal entry here would be to debit cash, debit subscription receivable, and credit common share subscribe. Lastly, the journal entry that means the distinguishment of subscription receivable is to debit cash and credit share subscription receivable. Let's move on to the distribution of certification. The distribution of certificate will be given to the shareholder once the payment is done. Here, the journal entry is to simply debit common share subscribe and credit common shares. Before we move on to journal entries and problem solving, let's go through terms that need to be taken into consideration. Declaration date. Once the board declares a dividend, the company records an obligation to pay through a dividend payable account. The journal entry here is to debit retained earnings, while we credit dividends payable. Ex-dividend date. The date on which a share trades without the right to receive a dividend that has been declared. Prior to the ex-dividend date, an investor would be entitled to dividends. Here, there is no journal entry. Date of record. The date when the company complies the list of shareholders to receive dividends. Here, there is also no journal entry. Payment date. When the cash or other form of dividend is actually paid to the shareholder. Here, the journal entry is to debit dividends payable and to credit cash. Let's have the following scenario. An existing business, Outlast Incorporated, specializes in both marketing and advertising. They've authorized 100,000 common shares and 50,000 preferred shares. Since we are following the basics, we will focus on common shares, but essentially, common and preferred shares are similar, except they differ in voting rights and pay priority. So back to the scenario. What if there was a person who plans to buy a stock? Let's call our buyer Sandra. She has an intention of purchasing 20,000 common shares with a par value of 5 pesos. So, in the perspective of Outlast Incorporated, the journal entry would be debit cash 100,000 pesos and credit common or ordinary shares capital with the same value because she paid that much for the stock. Now, let's assume that she is planning to have a down payment of 20% of the common stock and pay the rest in a later date. So the journal entry would be debit cash 20,000, debit subscription receivable 80,000, and credit common shares capital 100,000. This is because there is a down payment of 20%, and the rest of the 80% would be considered as a receivable. When Sandra paid the rest of the receivable, the journal entry would then be debit 80,000 cash and credit subscription receivable of 80,000. This is when Sandra paid for the rest of the money that she owed. Once she has successfully paid for the stock, she will be issued a stock certificate with the journal entry of debit common share subscribe and credit common shares. We hope you got something from accounting for transaction and shareholders' equity.